$45 million did not vanish in one wire, it moved quietly. First through a consulting invoice, then through a holding company, then through a private bank account on an island where secrecy was part of the business model, then into another account and another, until the money looked less like stolen capital and more like ordinary international finance. On paper, it was clean. In reality, it was a trail. 5 offshore accounts, 3 jurisdictions, 1 corporate empire that looked successful from the outside, and 1 mistake so small that at first, nobody thought it mattered. But that detail would later turn suspicion into evidence. The man at the center of the case was not the type of person people expected to see inside a financial crime investigation. He was not loud. He was not flashy. He did not post pictures with luxury watches or rented sports cars. He presented himself as disciplined, private, and almost boring. He built his reputation in logistics, technology services, and international supply contracts. His companies moved equipment, software licenses, and consulting services across borders. That meant foreign payments were normal. Offshore entities were not unusual. Multiple currencies were expected. And that was the perfect cover. Because when money moves through a business that already operates internationally, suspicious transfers can hide inside ordinary paperwork. A wire to a foreign vendor does not look strange if the company has foreign vendors. A management fee does not look strange if the company has foreign managers. A licensing payment does not look strange if contracts say intellectual property is involved. But here's the thing. Fraud often survives because the story sounds reasonable from far away. It collapses when someone gets close enough to compare the story to the records. The first signs came during a civil dispute over ownership, debt, and missing company funds. The numbers did not match. Revenue had increased. Contracts had expanded. Bank activity showed strong cash flow. But the available cash was gone. Executives were told the company was under pressure. Employees were told margins were shrinking. Creditors were told payments were delayed because of market conditions. Investors were told capital had been reinvested into overseas expansion. That explanation worked for a while. Then a forensic accounting team asked a simple question: where did the money actually go? At first, the answer seemed buried under thousands of transactions. There were invoices for consulting, vendor agreements, licensing contracts, service retainers, intercompany loans, payments marked as compliance fees, regional support, market development, and technology access. Individually, none of them proved anything. Together, they formed a pattern. The same amounts appeared again and again. The same payment descriptions were reused. The same approval signatures appeared on documents that were supposedly created by different companies in different countries. And then investigators found the first offshore account. It belonged to a company that had no real office, no employees, and no clear business purpose. Its registered address was shared by hundreds of other entities. Its director was a nominee. Its website had been created after the first payment was sent. Yet this company had received millions. According to the internal records, the offshore company had provided strategic advisory services. But nobody inside the business could explain what advice had been given. There were no reports, no meeting notes, no deliverables, no emails showing meaningful work, just invoices, and those invoices were paid quickly. That mattered. Because real companies often argue over invoices. They review them. They ask questions. They negotiate dates. But these invoices moved through the system with unusual speed. Approval came from the same executive office every time. The payments were marked urgent, even when the supposed services had no deadline. From there, the trail moved to a second offshore account. This one was held by another company in a different jurisdiction. On paper, it looked unrelated. Different name, different registration number, different bank. But the money told a different story. Transfers from the first account landed in the second account within days, sometimes within hours. The amounts were slightly reduced as if fees had been deducted. Then the money moved again. That is when forensic accountants began mapping the flow. They were not looking for drama. They were looking for repetition, timing, descriptions, counterparties, shared addresses, shared directors, shared phone numbers, anything that connected one layer to the next. And this is where it gets interesting. The third account was not under a company name. It was linked to a trust. On paper, the trust existed for asset protection and estate planning. It held investment positions and claimed to act independently. Its documents used formal language: protector, settlor, beneficiaries, discretionary distributions. But the trust had a problem. It behaved like a personal wallet. Payments went out for luxury travel, property deposits, private school expenses, legal retainers, art storage, renovations, even a yacht management company. The official explanation was that these were investments, loans, or administrative expenses, but the pattern was personal. And investigators knew that when a trust claims independence but pays personal bills on command, the paperwork may not reflect reality. Still, they needed proof. Suspicion was not enough. The fourth account brought them closer. This account received funds from the trust and then converted part of the money into digital assets through a regulated exchange. The transaction records showed transfers into a wallet, then movement across several addresses. Now the case had another layer. Crypto can make a trail harder to understand, but it does not make it disappear. Every transfer leaves data. Every conversion creates records. Every regulated platform has customer files, device logs, login histories, and withdrawal records. Investigators did not need to know every technical detail. They needed to connect the money leaving the offshore structure to the person controlling it. And then came the mistake. The fifth account was supposed to be the final landing point. It was opened under the name of a small investment company. The company claimed to manage capital for a group of private clients. The bank file looked complete: corporate documents, compliance forms, beneficial ownership statements, source of funds explanations. But one document was reused. A proof of address file submitted during onboarding matched a document from another account in the chain. Same PDF metadata, same scanner ID, same creation timestamp, same invisible formatting marks. At first it looked like an administrative shortcut. In reality, it was the fingerprint. That one reused document connected two entities that were supposed to be separate. Once investigators had that link, they went back through the records. They compared signatures, they compared IP addresses, they compared invoice templates, they compared the language in emails sent to banks and lawyers. The wall began to crack. The same person had accessed multiple accounts from the same device. The same assistant had transmitted documents for entities that claimed to be independent. The same law firm had created companies that later exchanged funds with each other. The same executive had approved the original payments from the operating business. And that changed everything. The case was no longer about a missing balance. It was about control. Control is the question that destroys many offshore stories. Not just who owns the company on paper, not just whose name appears in the bank file, but who gives instructions, who benefits, who signs, who moves money, who knows where the funds are going. The records showed that the offshore companies had no real commercial function. The trust was not independent in any meaningful way. The investment company was not managing outside client funds. And the crypto movement did not break the chain. It simply added another set of records. What investigators found next made the timeline even more damaging. The largest transfers happened right before major financial disclosures were due. Money left the business shortly before investors were given reports. Offshore payments increased when creditors started asking questions. Personal expenses through the trust rose during the same period the company claimed it could not meet certain obligations. On paper, the business was struggling. Behind the curtain, money was being extracted. The defense was predictable. The payments were legitimate. The offshore entities provided services. The trust was lawful. The crypto transactions were investments. The executive did not personally control every account. The documents were handled by professionals. And some of that may have sounded plausible in isolation. But forensic cases are not built from one document. They are built from the way documents collide. The consulting invoices had no support. The offshore companies had no staff. The trust paid personal expenses. The crypto wallet linked back to exchange records. The fifth account reused a document from another entity. And the same digital fingerprints appeared across the structure. That detail mattered. Because fraud does not always get exposed by a confession. Sometimes it gets exposed by laziness. A copied file. A repeated phrase. A login from the wrong device. A signature that appears where it should not. A document created before the company supposedly requested it. In this case, the fatal mistake was not moving money offshore. It was assuming the paperwork would never be compared. Once the pattern was established, the consequences came fast. Accounts were frozen. Civil claims expanded. Regulators were notified. Bank compliance teams reopened old files. Lawyers demanded production of documents. Auditors revised their findings. Investors began asking whether prior statements had been misleading. The personal consequences were just as severe. Reputation collapsed. Business partners walked away. Lenders tightened credit. Employees feared the company would not survive. Family members connected to the trust were pulled into questions they never expected to answer. Advisors who had helped create the structure faced scrutiny over what they knew, and when they knew it. Now, not every offshore account is illegal. Not every trust is fake. Not every foreign company is suspicious. International business can be legitimate. Asset planning can be lawful. Cross-border payments can be ordinary. But secrecy becomes dangerous when it is used to hide control, disguise ownership, or move money away from the people who have a legal right to know where it went. That is the difference. And it is the reason forensic accountants do not chase rumors. They chase records. They follow dates, amounts, bank references, beneficial ownership forms, device logs, email headers, property files, exchange statements, board minutes, invoice numbers, transfer instructions. The money may move across borders, but the evidence moves with it. By the end, the $45 million was not a mystery anymore. It had a root. It had timing. It had documents. It had beneficiaries. It had a structure. And most importantly, it had a mistake that tied the entire chain together. 5 accounts were designed to create distance. One reused document destroyed that distance. And that is the lesson hidden inside the case. People who hide money often believe complexity is protection. They believe more entities create more confusion, more jurisdictions create more delay, more paperwork creates more credibility. But complexity also creates more chances to make an error, a wrong timestamp, a repeated file, a shared address, a matching login, a payment description copied too many times. The hidden dollar always asks for one thing: a place to land. And once it lands, it leaves a trace. And if you want more real cases of hidden money, offshore fraud, and forensic justice, subscribe to Hidden Assets Exposed, because every hidden dollar leaves a trail.